Hi, my name is Alex Carlucci with Gustin Cho Associates. Today we're going to discuss debt-to-income ratio and what that means and what you should know as a consumer. Maybe how you can do some quick math at home and see if you're within range and maybe what you can do about it. So let's just start with conventional. Their debt-to-income ratio maximums are 50% over 50%. What that means is 50% of your income can go towards your mortgage payment on the front end, and then with the debt, the back end, the mortgage payment plus all your monthly debts, like a car payment, credit cards, added to your mortgage payment altogether can't exceed 50%. So if you have no debt, your mortgage payment basically could be 50% of your gross monthly income. So let's use a standardized income. Let's just pretend your salary, because income is complicated and it's hard to calculate your own income if you have complicated income. But let's just go off of $5,000 a month, and let's just call that a salary, and that's $60,000 a year. So $5,000 a month, 50% DTI would be $2,500. That's half of $5,000. So that would be your max mortgage payment if you had no debt, and let's say you had $500 a month in debt, like a car payment was $400, and your minimum credit card payments add up to $100. That would be $500, and you take that off the $2,500, you qualify for it max, and that leaves you at $2,000 for the front end. So your mortgage payment can't exceed $2,000 with everything included, and that includes principal and interest, which is what we calculate with the interest rate. Your taxes, which is the tax bill, which is a year of taxes divided by 12 is added to your payment. A year of insurance divided by 12, that monthly amount's added to your payment. And if you're putting down less than 20% conventional, you'll get PMI, and that's more complicated. You have to talk to your loan officer what that amount would be. So that's how conventional debt-to-income ratio works, and there's really no exceptions to that. Once in a blue moon, I've gotten Freddie Mac to approve it at 50.5, 51, once in a blue moon with a ton of assets and really good credit score. I don't know why that works out sometimes. It's up to the computer, but it's not something you can bank on at all, 50%. And there's really no exception to that rule. That's if your debt to income's higher, who cares if you've got $10 million in your bank. Now, if you got $10 million in your bank, I could take you to a different program, but I'm just letting you know that there's no exceptions to that rule. It's about math. So if you can sit at home and do some scratch paper and see that the math doesn't work, then maybe you have to find a way to pay off some of that debt. So if you had $500 a month in debt and you wanted your mortgage payment to be $2,500, so pay off all your debt, including your car, and now you qualify for $2,500. So that's one way to fix DTI issues, paying off debt. Another way is buy down the interest rate, get cheaper insurance. There's all sorts of different little tricks we have to get your debt-to-income ratio down. So we do this all across the board with FHA, VA, and IQM. So let's move on to FHA. FHA, when someone has a lot of debt and they want to buy a house but they don't qualify for conventional, FHA lets you go to 56.9%. So basically 57% on the back end and 46.9% on the front end. So they have a lower front end ratio but a higher back end ratio. So if you have no debt and you have great credit, I'm thinking conventional, because you can go to 49.9 over 49.9, so the front end could be higher than it can be FHA. You got a lot of debt and your back end exceeds 50%. I'm thinking FHA, but now we have to make sure the front end doesn't exceed 46.9%. So as long as that we stay under 46.9 on the mortgage payment divided by your gross monthly income, and we stay under 56.9% with your mortgage payment plus your monthly debts, divided by, your gross monthly income is less than 56.9, then you're within the guidelines. Now, again, with conventional and with FHA and VA, because that these are the limits, it doesn't mean everybody's okay. If you got a lower credit score, it might only approve you at 42 back-end ratio. It's just up to a computer sometimes. Now, we do manual underwriting for FHA and VA, and there's lots of complications to what debt-to-income ratios we go to, but we'll go in that into another video. We'll talk about debt-to-income ratios for manual underwriting. Right now, I just want to teach consumers how to do a basic scratch paper debt-to-income ratio calculation. Now, when it comes to and I'm using really good credit for this example, because really good credit always usually gets approved with the maximum. So on VA, we got we can go to 65, no problem. We really have no overlays. So if you get a 71 DTI and it gets approved, we have investors to get it done. It just starts to get harder to pass what's called a residual income. And we find that 65 DTI is a safe number for someone with a high income to pass the residual income. But that's a safe number for you guys to use at home with really strong credit. It's not safe for you to try to push it a little higher and hope that you get that residual income pass and you get the approved eligible on the computer. So keep in mind 65%, and that's front end and back end. So that's how VA works. Residual income test is what we worry about with the high DTI on VA. And what that is it really calculates what your gross income is minus what you pay for taxes to the IRS in that pay stub. And then it has a formula for calculating like your electric bill. And then they take little factors out for your family size, and it leaves you with this amount of money left over. And then there's a chart you go to and see if you have money left over after paying your bills. If you got more than the chart says, then you're okay, you pass residual. So it really is a make sense, like how much money does this person really have left over after they pay their taxes and some of their bills, and how big is their family? Do they have money to survive in case, any kind of mini emergency? Your car breaks, $2,000 you have to pay to fix your car. So that doesn't take you out because you have no money left over every month. So that's how the residual income test works. And then when it comes to non-QM, most of them are about 50 DTI, and we have a few that go to 55 DTI. Non-QMs is our bank statement loans, because the rest of our non-QMs are mostly no documentation loans. We do have full documentation non-QM loans that would cap you at 50, and we do have one or two that go to 55 in a rare case. So that's how debt to income ratio works, and those are different limits that we can go to on those programs. And every so often we'll do a USDA loan, and those are a little more tight. So those are 29% front end and 41% on the back end, and that front end ratio and back end ratio are real tight, so you can't exceed either one of them. So your mortgage payment cannot be basically more than a third of your gross monthly income. So keep that in mind when you're trying to calculate your own scratch paper at home to see if you qualify, and maybe some work you have to do before you give a mortgage broker a call. If you want to get a mortgage with us, we have 48 states. We got loan officers all over. We'll call you. We're always open. My phone number is 630-915-7550. Give us a call anytime. Thank you very much.